the fourth consecutive decline, and ECB staff projected to slow markedly again next year. Despite weak productivity, unit labour costs grew less strongly in the second quarter, by 4.6% after 5.2% in the first quarter. Staff expect unit labour cost growth to continue declining over the projection horizon, owing to lower wage growth and a recovery in productivity. Finally, profits are continuing to partially offset the inflationary effects of higher labour costs. The disinflation process should be supported by receding labour cost pressures and the past monetary policy tightening gradually feeding through to consumer prices. Most measures of longer-term inflation expectations stand at around 2%, and the market-based measures have fallen closer to that level since our July meeting. Let's look at our risk assessment. The risks to economic growth remain tilted to the downside. Lower demand for euro area exports, owing, for instance, to a weaker world economy, or an escalation in trade tensions between major economies, would weigh on euro area growth. Russia's unjustified war against Ukraine and the tragic conflict in the Middle East are major sources of geopolitical risk. This may result in firms and households becoming less confident about the future and global trade being disrupted. Growth could also be lower if the lagged effects of monetary policy tightening turn out stronger than expected. But growth could be higher if inflation comes down more quickly than expected and rising confidence and real incomes mean that spending increases by more than anticipated, or if the world economy grows more strongly than expected. Inflation could turn out higher than anticipated if wages or profits increase by more than expected. Upside risks to inflation also stem from the heightened geopolitical tensions, which could push energy prices and freight costs higher in the near term and disrupt global trade. Moreover, extreme weather events and the unfolding climate crisis more broadly could drive up food prices. By contrast, inflation may surprise on the downside if monetary policy dampens demand more than expected, or if the economic environment in the rest of the world worsens unexpectedly. Financial and monetary conditions. Market interest rates have declined markedly since our July meeting, mostly owing to weaker outlook for global growth and reduced concerns about inflation pressures. Tensions in global markets over the summer led to a temporary tightening of financial conditions in the riskier market segments. Overall, financing costs remain restrictive as our past policy rate increases continue to work their way through the transmission chain. The average interest rates on new loans to firms and on new mortgages stayed high in July at 5.1% and 3.8% respectively. Credit growth remains sluggish amid weak demand. Bank lending to firms grew at an annual rate of 0.6% in July, down slightly from June, and growth in loans to households edged up to 0.5%. Broad money, as measured by M3, grew by 2.3% in July, the same rate as in June. To conclude, the Governing Council today decided to lower the deposit facility rate by 25 basis points. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. We will keep policy rates sufficiently restrictive for as long as necessary to achieve the same. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restrictions. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. And we are now ready to take your questions.
Thank you, President Lagarde. And the first question goes to Annette Weisbach of CNBC. Annette, please.
President Lagarde, thank you very much. I have a question, of course, on the decision to cut by 25 basis points versus 50. So why did you go for 25? And my second question is looking into the future, given that the Fed also is going to start to cut. The macroeconomic picture is gloomier than before. Inflation is coming back. So what is the market right to anticipate that you cut another 50 by the end of the year? Thank you.
Thank you so much, and good afternoon, and it's nice to see you all after the break, first of all. So on your question about our decision, we decided to cut the deposit facility rate by 25 basis points, and that was a unanimous decision. We proceeded as we normally do and have very clearly indicated by obviously looking at data and looking in particular at data through the prism of our three key criteria. So when you look at the incoming information, it confirms our previous projections, and it comforts us in our confidence that we are heading towards our target in a timely manner. So during the course of 25 in particular, inflation will decline towards our 2% target. And we thought that given that gradual disinflationary process, it was perfectly appropriate to moderate the degree of monetary policy restriction by cutting our deposit facility rate, which I will call the DFR, if you don't mind. From now on, it's the deposit facility rate by 25 basis points. When I said that we looked at all the information that we get on the occasion of a projection exercise through our three prisms, I'm referring obviously to the inflation outlook, I'm referring to the underlying inflation, and I'm referring to the transmission of monetary policy. And, you know, on the inflation outlook, when we receive the projections of our staff for September, it's virtually unchanged relative to June for the inflation outlook. And it continues to see a return to 2% before the end of 25. And this is, by the way, the 5 consecutive projection exercise pointing to that 2% at the end of 25. So why do I say that? Because it certainly reinforces our confidence in the solidity and robustness of those projections. That's for the first prism, the inflation outlook. The underlying inflation, on the other hand, we look at the various indicators that we have, from domestic to PCCI, and here we see one particular indicator, the domestic indicator, which is abating a little bit because it moved from 4.5 to 4.4 between June and July, and it is not satisfactory. It is resistant, it is persistent. This is the reason why we have to be resilient in our approach and very attentive to the various components of core inflation as measured by those various indicators. The third prism is the policy transmission. And on that front, we all observe that the financing conditions continue to be restrictive, and the footprint of our monetary policy in the real economy has been visible. So, on the basis of that review of incoming data, staff analysis, consistency of the projections for the 5th exercise in a row, that decision to cut by 25 basis points was perfectly legitimate and, as I said, unanimously decided. I drink to the future. Well, future, I'm tempted to quote, Spanish, que será, será, because we have consistently said, and we repeat again, that we shall remain data dependent, and that is particularly justified in view of the uncertainty that abounds. So we shall be data dependent. We shall decide meeting by meeting, and our path, of which the direction is pretty obvious, a declining path, is not predetermined, neither in terms of sequence nor in terms of volume. And I would like to add one thing which I have already said before, which is still true, which is that data dependency does not mean data point dependency. We're not going to be fixated on one single number. We are looking at a whole battery of indicators. And I'm saying that in particular because September will certainly deliver a low reading of inflation, very likely. We expect, because of the base effect, particularly on energy, our inflation numbers to be up in the fourth quarter, so the last 3 months of 24, but September is going to deliver a low reading. But we're not just looking at one indicator. We're looking at a whole range of data that we receive.
Thank you, Madame Lagarde. And the next question goes to Francesco Canepa of Reuters. Francesco, please.
Thank you very much. Good afternoon, everybody. The October meeting is a short 5 weeks away. So, to use your own words from March, do you think you will know a lot more or just a little more come October 17th? Second question is about something else. It's about something that the ECB has been championing for years, and that is cross-border consolidation between banks. It seems it's finally happening, with UniCredit building up a stake in Commerzbank. So does the ECB welcome this development?
Thank you very much for your two questions. On your first questions, we can all count. It is 6 weeks before October 17th, which is a relatively short period of time compared to other intervals that we've had in the past. I would simply repeat what I have said. We are going to be data dependent. We are going to decide meeting by meeting. I'm not giving you any commitment of any kind as far as that particular date is concerned. And our path is not predetermined at all. On the other matter that you referred to, typically we do not comment on individual institutions. And as you know well, we have a clear procedure which involves our supervision authority, the SSM, which at certain thresholds of equity ownership or transfer of shares, if you will, has to be consulted, has to authorize. And of course, I'm confident that the authorities of these institutions concerned, namely UniCredit and Commerzbank, will be perfectly aware of their regulatory requirements and will comply with such requirements. The SSM will do what it has to do in full independence. And clearly, cross-border mergers have been hoped for by many authorities, and it will be very interesting to see that process unfold in the weeks to come.
Thank you. And the next question goes to Mark Schroers of Bloomberg. Mark, please.
Yes, thank you. The first one, you said again that the rates needs to be sufficiently restrictive for some time. How many times can the ECB cut interest rates before they are no longer sufficiently restrictive? So basically, where do you see the so-called neutral rate? And the second one is more on the effect of interest rate cuts. How much of a boost could such cuts deliver to the euro area economy, given that at least some, if not most, of the problems are structural? Thank you.
I'm going to thank you for your two questions. I'm going to spend a bit more time on your second question, because on the first one, how long are we going to be sufficiently restrictive? Until we have been sufficiently restrictive. Because what we want is to achieve the goal of returning inflation to target in a timely manner. As I said, for the fifth projection exercise, we have inflation at target during the second half of 2025, and that is on the basis of the baseline that we have in our projection. And we're going to observe how that baseline evolves over the course of time as data comes in to decide for how long we have to continue cutting rates and at what point we have been sufficiently restrictive. So I'm not going to give you any idea as to where our star is, because this is an unobservable concept anyway, and we will, as we get closer to it, we will know certainly better. As you probably know, staff has produced a very good paper on our star, which indicates that it's probably a tad higher than where it used to be. But, I'm not endorsing this. I think, as I said, as we get closer to it, we will know better whether we are there, and there are multiple factors that are going to impact on that. Now, your second question, is this 25 basis point cuts going to be a boost for our economy, given that so much is structural? So, I know I'm preaching the converted here, but obviously there is a lag between the time when we make a decision and the impact is actually felt and can be observed in the economy. What we are still observing at the moment is the impact of our tightening decisions from more than a year ago, almost 2 years ago now. This continues to have an impact. We believe that the peak has been reached in relation to GDP, but there will be continued, although downward sloping, effects of those decisions, and we will have the same kind of lag applying to the decision that we are making now. So that's point number one. The passing of time does not satisfy the instantaneous satisfaction that we would have to see the results coming out of our decisions. This is the reality of monetary policy and the functioning of our economies. The second part of my answer to your question, because you do refer to structural causes, gives me a chance to actually commend the Draghi report. We haven't had time to dissect everything, neither has anyone for that matter, because it's sufficiently substantive and material enough to require more time and special attention. But it's a formidable report in that it poses a diagnosis which is severe, but which is just, in our view. And it also points to structural reforms, practical proposals to achieve such structural reforms that could be extremely helpful for Europe to be stronger, but also for us as central bank to achieve better results in our monetary policy. If productivity can rise as a result of the structural reforms, for instance, that would be very good news for us. If the capital market union can be implemented and more financing be made available in order to finance innovation, that is good news for us as well when it comes to inflation, price stability, and the components that underlie this work that we do.
Thank you, Madame Lagarde. And the next question goes to Aude Kersulek of BFM TV. Aude, please.
Thank you for having my question, Madame Lagarde. Are you worried about the risk of below target inflation? In France, INSEE estimates that inflation will be 1.6% in December, and we can add that oil prices are at the lowest since COVID, so is it a risk? And second question about the Mario Draghi's report. Can it have an impact on monetary policies, on the ECB's mandates? Thank you.
As you will appreciate, I'm not going to give you an answer that is country-specific because we work on a euro area basis. But obviously, it's a risk that we have to be attentive to, which is why we are targeting that 2% sustainably. Has to be asymmetric in the medium term, as we have anticipated in our strategy review, which remains completely valid. You mentioned two things. You mentioned one thing in particular. You mentioned energy. Well, energy has been one of the key factors that took prices up, directly and indirectly through all sorts of channels. And in the same vein as it took prices up, it is helping to move prices down. Well, this is an exogenous matter, and this is one, that can move again, and that we have to be prepared for. The second question you ask is, and I think I have partially responded to your question, some of the proposals in the Draghi report, as well as in the Letta report, by the way, because achieving the single market and improving the competitiveness in our view can be very complementary. But some of those proposals touch directly on what we are specifically concerned about. And the Capital Market Union is one in particular on which the Governing Council has had a strong view and issued a special opinion upon. In the same vein, the financing of innovation, the increase of productivity, the competitiveness in relation to its external position, all of that actually matters when it comes to the work that we have to do. I didn't see in Mario Draghi's report any suggestion that the mandate of the ECB should be modified. We have a single mandate, as you know, which is price stability. We comply with the treaty and with the mandate that was given by the founding fathers of Europe. And hopefully we can, not hopefully, but we will deliver on that mandate. And whatever is suggested by Mario Draghi has a lot more to do with structural reforms. And I very much hope that the executive authorities in charge will actually take it to heart and will see a path towards those structural reforms.
Thank you. Turning to the remote participants, I'd like to give the floor to Martin Arnold of the Financial Times. Martin, please.
So Martin is still with us?
Today.
Anyway, hello, President Lagarde. Two questions from me, if I may. Firstly, I'd like to ask about services inflation, which the latest reading showed went up again. How much concern does that give you? And what do you see as the risks going forward on that, as you've raised your forecast slightly for core inflation? And the second question, if I may, is back on the Draghi report. Does the ECB intend to adjust monetary policy in any way to facilitate implementation of Draghi's proposals? Thank you very much.
Well, thank you so much for your two questions. And thank you for pointing to this services inflation, because that is clearly the component of prices that requires very attentive understanding, monitoring, and I'll come to that in a second. But suffice to say that it went up from 4.2 to 4.4. So whereas so many other components are on a declining path, that particular segment is increasing. And we've tried to decompose what is behind it, and it's a combination of holiday packages, insurance, and I'm trying to remember what is the third one. I'll come back I'm sure it will come back, but it's predominantly these two. We are looking attentively to the nexus of three elements. Number one, wages. Number two, profits. Number three, productivity. And services is particularly sensitive to wage increases. So our expectations is that services inflation will decline over the course of 25. Why? Because what staff had anticipated, which is moderation of wages growth, buffering of wages cost by slightly declining profit, and increase of productivity is actually being demonstrated by numbers, by observations. If you look at wages, whether you look at compensation per employee, whether you look at negotiated wages, whether you look at unit labor cost, all of that is going down. Wage tracker, same thing. And our expectations is that it will continue to go down in the course of 25. We will, on negotiated wages, we will still have relatively high numbers. And we know that some are in the making at the moment. The auto workers unions, the IG Metall request, and in various other countries, but with some heterogeneity, will continue to move wages higher in the first half of 25, but then it's definitely on a decline path. It is already the growth is on a declining path, but it will pick up again in the latter part of 24, very early in 25, and then it will continue to decline. And the numbers that we have for growth in wages, I will share with you. I've got my unit profit growth. So I'll give you the number later if you're interested, but it is definitely declining. That's on the wages. On profit, we are now observing from high numbers that we had at the end of 20 up until the end of 23, we are seeing declining numbers on profits. And as a result of that, you can obviously deduct that profits are actually buffering and absorbing some of these labor cost increases. On productivity, it is also on a declining path, moderate and not it's on an increasing path as considered and envisaged by staff, a little less than what they had projected, but it's also heading in the right direction. So that really confirms the views that they had taken initially, and that has given us confidence that services will move downward as well, that wages growing moderately and more moderately now, profit absorbing more wages, and productivity increasing a little bit by virtue of, cyclicality, will lead us to having services prices less than where they are at the moment. But it's obviously a sector that is, as I said, which is resistant and on which we have to be very attentive. You had a second question, if I remember, and I'm trying to... Oh, yeah. Mario Draghi's report includes so many important structural reforms that are going to be the responsibility of governments, that will require the leadership of the Commission and the leadership of those leaders in Europe who are determined to strengthen Europe, to give it more sovereignty, to give it more capacity in the current geopolitical circumstances, that I'm really certain that monetary policy will do what it has to do, which is to provide price stability and to deliver on its mandate, while structural reforms are not the responsibility of a central bank. They are the responsibility of the governments.
Thank you, Madame Lagarde. And staying with the remote participants, I'd like to give the floor to Silvia Berzoni of the Italian TV channel Club CNBC. Silvia, please.
Thank you very much, Wolfgang. So good afternoon, President and Vice President.
Good afternoon.
I will have two questions, if I may. The first one is, were you expecting such a slowdown in German economy? And how does it factor in your projections and balancing of risks? And the second one, I would like to go back on UniCredit Commerzbank. So in compliance with all the prudential requirements and buffer, do you believe that the emergence of a pan-European bank could be a positive for the industry as a whole and Eurozone? Thank you very much.
You know, our staff provides projections, goes into real in-depth analysis of the situation of every country, and receives the feedback of the National Central Bank. So they don't provide projections, or they don't provide analysis in the vacuum of the wonderful main building and Euro Tower of the ECB. We do reach out, we do work together on a Eurosystem basis. And the slowdown of the German economy was certainly anticipated by the Bundesbank, certainly the ECB as well, and shared on a Eurosystem basis. So it's embedded and included in the projection that we have. And we analyzed that very carefully with members of the Governing Council in the last couple of days, because there is clearly heterogeneity amongst various countries. When you look at countries separately as they come together to form the system, you see, for instance, that at the moment, Spain or the Netherlands are delivering strong GDP numbers, while at the other end, Germany is on the other side. Your other question about pan-European banks. I think there are quite a few pan-European banks. What you're talking about here is more a cross-border merger between two large national institutions. And that is something which, as I said, will be reviewed from a regulatory standpoint, and which certainly will satisfy many of those who have expected cross-border mergers to result from, banking union when it is achieved. So.
Thank you. And the next question goes to Christian Siedenbiedel of Frankfurter Allgemeine Zeitung. Christian, please.
Yes, thank you very much. You emphasized that one part of the decision with the deposit rate was anonymous. Were there other parts of the decision that weren't anonymous?
What part of the decision? We had extensive discussions on all the data that we received, all the analysis that was produced by staff. And, we tested the rationale behind the current recovery, which is moderate, and the pickup in recovery that we expect in 25 and 26. And I think we were convinced that while consumption is low and has actually weakened, it should economically result from the combination of higher net income, fading monetary policy impact, and low inflation. It should necessarily result from those forces that consumption and investment actually pick up. So we tested all that, and we discussed, and some tend to be a bit more pessimistic, some are more optimistic, but we really discussed in depth the rationale behind those outlook numbers that we have for 24, for 25, for 26. And the reason why we revised by 0.1% only, is really a combination of reduced net export numbers, given the uncertainty and the geopolitical risk that we have going forward, and a carryover of the situation that we have now, which is reduced activity because consumption has been lower than we had anticipated. But as I said, we are going to assess each and every time along the way all the data that come in and see that we continue to reach our target in a timely manner.
Thank you. And the last question today goes to Andres Stumpf of Expansion. Andres, please.
Thank you, Madame Lagarde. I have two questions. I have one about the projections. On the one hand, we have no changes in the inflation side, but on the other hand, we have our revision in growth outlook caused by a weaker internal demand, which is the main contributor to inflation. How does this add up? And the other question is, I saw you welcome Mr. Escrivá, the new governor of Banco España, and I was wondering if you could tell us your first impressions and what do you expect from his contribution to the Governing Council. Thank you.
Thank you very much for your two questions. So you are correct that our projection numbers for HICP, which is the headline inflation, have not changed a bit. They are the same as in June. We haven't revised. The one that we have slightly revised is core inflation. We have revised core, which takes out energy and food by 0.1%. Well, we have revised 24-25. We have not revised 24-26. And that is caused by what? By the fact that energy prices have significantly impacted downward and have benefited to the headline inflation. The fact that food has slightly increased but very little. And as a result of these two components, there's a bit of a trade-off and a net-off, if you will, with other prices, notably services. Now, we have revised downwards the outlook for growth because the consumption that we had anticipated for now, essentially, because net income has begun to increase, inflation has gone down significantly, and we were expecting consumption to pick up, has not picked up. And I think that we will be looking at that carefully when we produce our next growth and GDP numbers. José Luis Escrivá has joined the circle of the governors, and we have greeted him, we have welcomed him in the circle of governors. Like other governors, he has made some very useful contributions, and I hope, like any other governor, he will continue to not only give his personal views, and which might be inspired in part by, the Spanish situation, but he will have this European dimension that other governors also have when they sit around the table of the Governing Council. And it is a process, and it's a journey that I hope will be productive and pleasant, both for him and for the group of governors around the table. But I can assure you that he was welcome, and he was contributing.
Thank you. That concludes our press conference. Thank you very much for participating. The next press conference will be on 17th of October, and that will be the external Governing Council press conference, which will take place in Ljubljana in Slovenia. Yeah. Thank you very much.
That was ECB President Christine Lagarde. Let's get over to Bloomberg's Lizzie Burden at the ECB in Frankfurt. And Lizzie, I want to ask first about her comments on growth. I'm watching here the FTSE, the CAC 40, the DAX. They've all trended lower and lower and lower, given up their gains for the day. Is there a growth scare in Europe?
I thought it was interesting that the inflation outlook didn't have a particular bias, but there was one on growth, Matt. She says that the risks to growth are tilted to the downside, whereas for inflation, there's no change to the forecast. For growth, they've changed their forecast lower for this year and the years ahead. So that's notable. It's a difficult outlook to navigate as they go ahead. She's talked about this meeting being unanimous on the Governing Council, but behind the scenes we know that they're divided over where the neutral rate lies. She wouldn't comment specifically on where she thinks it is, though she said it would be simpler to know as they get towards it. And it's no surprise, therefore, that she didn't want to give anything away about whether there's going to be an October cut. She says it's going to be data dependent, meeting by meeting, and they're not fixated on a single number, she says. So don't go crazy, is what she's saying to traders, if inflation drops in September, because it could rise again.
All right, don't go crazy, Lizzie Burden. Really appreciate your reporting. That's Lizzie Burden at the ECB in Frankfurt, of course, after the bank cut rates by 25 basis points, but was clear on the future path not being predetermined. Meanwhile, let's get over to U.S. markets. The U.S. market has been open for about 7 minutes, and stocks are searching for direction after that big reversal we saw yesterday. The S&P 500 currently flat, a little bit higher right now, maybe if you're an optimist. Same thing, too, if you take a look at the NASDAQ 100. Of course, NVIDIA saved the day yesterday, really leading that rebound we saw on the NASDAQ 100, on the S&P 500. The Russell 2000 is your leader at the moment. The small cap index currently up about 0.5%. Meanwhile, some stocks to keep an eye on at the open. We have shares of Alaska Airlines soaring after the company raised EPS and profit expectations for the current quarter, riding a wave of strong travel demand and lower fuel costs. Meanwhile, Delta sees adjusted EPS for the full year above $6.50. That is in line with previous estimates. Sonali.
I'm also keeping an eye, Katie, on Moderna, which plans to reduce its research and development budget by almost 20% over the next 3 years. The company is struggling with profitability as vaccine sales disappoint, Matt.
Yeah, and Oxford Industries is lower after the apparel company cut its annual adjusted earnings per share guidance to a level below the average annual analyst estimate. I should say Oxford owns Tommy Bahama.
Yes.
I just took off a shirt to put on this suit.
Thomas Bahama.
And Lily Pulitzer. Is that still a big thing?
For some people.
Yeah. Certainly a thing. It exists.
I mean, my daughter has a Lily Pulitzer onesie.
There you go.
You know.
Yeah.
And how old is your daughter?
10 months old. Let's take a closer look at retail costs and sentiment with Bloomberg's Abigail Doolittle. Abby, what have you got?
Well, we continue to have this bifurcation amid the consumer. Investors trying to figure out whether or not we have a strong U.S. consumer or a weakening U.S. consumer. Both may be true, and it depends on where you look. So Walmart, you can see over the last 2 months, up about 14% on the year, up even more. So that big box discount retailer, better prices, really doing well. And large part, we've been hearing stories about people with higher incomes recently shopping there for food. Procter & Gamble, good quarter recently. They've raised the growth looks good for some of their essential products. But when we go discretionary-wise, Urban Outfitters, July and August started to weaken. They're expecting that may continue into the second half. And just yesterday, designer brands over the last 2 months down 30%. They put up a bad quarter. This is, of course, the owner of Keds and DSW. So it really seems as though discretionary is not doing as well, whereas staples still hanging in there. If we connect this to consumer sentiment, because, of course, consumer sentiment will be out tomorrow. If we go into the Bloomberg terminal and take a look at what's happening here, well, actually, we don't have that. But what we do have is the bifurcation right here between that split between discretionary in orange, up about 7% on this year, so not so shabby. But take a look at staples and the S&P 500 up closer to, let's call it 16 to 17%. The big question is which side is quote unquote right, Katie? Which side is more accurately representing the consumer? We, of course, don't know that right now, but 66% of the economy, it's super important to watch, and, of course, for directions of stocks.
And, of course, we'll get another clue tomorrow. Abigail Doolittle, really appreciate that. Let's keep the conversation going now with iCapital Chief Investment Strategist Anastasia Amoroso joining us on set now in person. Great to see you.
Great to see you, Katie.
So Christine Lagarde just finishing up, of course, the ECB press conference. Compare and contrast her tone with what you're expecting to hear from Jerome Powell next week.
Yeah, I think it's quite different. What really strikes me is that Christine Lagarde seemed a lot less concerned about growth and a lot more concerned about inflation, and which is quite different. And I would say quite the opposite for the Fed, because the Fed is more concerned about the labor market. But, you know, she was really, I mean, there's really not much attention given to the growth outlook, which is weakened. And for example, for this quarter, just 0.3% annualized growth that's expected. You know, you would think that if this was in the United States, you'd have a pretty big reaction to that. But it's not the United States. You know, the other thing is she is quite concerned about inflation and hence the lack of willingness to pre-commit to the future path of rate cuts, I should say. So it is going to be meeting by meeting. It is going to be, even though she said don't pay attention to particular data points, but it is going to be, you know, watching the data points like inflation. And if the consensus estimates prove to be right and inflation does grind lower towards, I think, 2.3% by the end of next year, that will produce a series of rate cuts. And this is so different from the Fed because Fed Chair Powell has said that, well, we have a lot of room to work with, you know, when it comes to where the nominal Fed funds rate is, where inflation is, where the neutral rate is, and we're overly restrictive. So the Fed seems to have a greater willingness to move than the ECB.
Now let's talk about what's going to move the market as well. Is it really what's going to happen with the Fed at this juncture when you see kind of single names? NVIDIA yesterday really turned around the market here. You're looking at NVIDIA today trying to notch its fourth day of gains. Let's see if they can get there. It's been kind of staggering in the early trades. Is it really the AI trade when you see a day like today where almost all of the Philadelphia Semiconductor Index is dragged down once again?
Yeah. Well, I think there are two main stories or maybe questions that the market participants are trying to game out. The first one is, are we headed into a recession or are we not? And that's why you've seen the defensive sectors like utilities, for example, really outperform since about the middle of July. And I think this tug of war of data is going to continue, where we get a data point a little bit weaker. Oh no, we're going to recession. You get another one, and that sort of erases that fear. So, you know, so that's why I would expect the defensives to continue to provide the anchor and the pillar to the markets. But at the same time, Sonali, I do look very closely at the semiconductor space. And, you know, look, what happened to semiconductors, the valuations got very extended relative to the S&P, for example. The ratio was 1.4 times. Utilities, by the way, were quite cheap to the S&P. And so that has started to reverse over the last several months. So semis have come back down to earth in terms of valuations. They're not quite in line with the S&P. They're still expensive relative to their 10-year averages. But if you look at the multiple adjusted for growth on semis, it's actually below the long-term averages. So I think investors need to look at that very closely and say, well, do they expect the growth in semiconductors to continue? And what I heard from a lot of the Goldman Sachs tech conference reports, whether it was NVIDIA, whether it's Marvell, whether it's Broadcom, they are continuing to see very strong demand for artificial intelligence. And I think one of the reasons why NVIDIA, you know, had the standout day yesterday was because they also talked about how much additional rental revenue the hyperscalers can generate, you know, if they invest in NVIDIA chips. And so that ROI, I think, is so huge for the industry right now. And we seem to have it, so therefore that should support the investment cycle into semis. So despite the weakness, I think investors should be looking at this space and adding to it.
I looked at the intraday swings, and Jess Menton put together a chart for us to show on the S&P how big they are. Yesterday we had the second biggest intraday swing since 2022, and if you look at the chart, we're getting bigger groupings of bigger swings. Are we going to see this kind of volatility through September 18th? Does it go until November 5th? I mean, what is going to, you know, calm this market back down?
Yeah, I think, you know, plus or minus 1 month before and after the Fed rate cut, or maybe even extend that to 3 months before and after. I think it's normal to see elevated volatility because of what I mentioned earlier, is we're trying to figure out where the economy is headed. I think it's going to become clear where the economy is headed more so in the next 3 months, especially once some of those rate cuts start to filter through. So that's the first thing. The second thing is, elections certainly has a role to play. And if you look at the manufacturing numbers, for example, manufacturing activity has slowed down quite a bit, particularly the new order component. And I think that has something to do with the election, because if you are a company trying to invest in property, plant, and equipment, do you know what the rules are going to be? Do you know what the tax code is going to be? Do you know what the tax incentives are going to be? The answer right now is probably not. It's going to depend on the election outcome. So I think that's part of what's also producing this volatility in the equity market. And we also see this when we look at the Republican outperformance baskets, the Democrat outperformance baskets. So, Matt, I think there's a lot for markets to parse through, and that's what they do on a daily basis.
Anastasia, we thank you so much for your time. That is iCapital's Anastasia Amoroso in the middle of what's been a lot of volatility in these markets heading up to the election. Now, coming up, a double downgrade for Micron Technologies. We're going to tell you what's behind that call next in Top Calls. This is Bloomberg.
All right, it's time now for Top Calls. Some of the analyst action in focus this morning. And first up, BNP Paribas double downgrading Micron to a sell rating and slashing its price target nearly in half. The firm says that Micron will underperform its AI peers through 2025 thanks to an oversupply and impending correction in the chip memory market. Next up, Wolfe Research is upgrading Roku to a buy. The firm says that sales at the streaming video platform poised to accelerate from here. And remember, earlier this week, Wells Fargo's raised its rating on the stock thanks to the potential of its Roku channel. And finally, we have Stifel cutting its rating on Simon Property, saying that the stock is no longer a buy. The firm says that the company has outperformed the sector this year and cautions that shares could lag in the near term, Matt.
All right, coming up, junior bankers are getting their hours capped at JP Morgan in a good way. That and more on our Wall Street Beat. This is Bloomberg.
This is Bloomberg Open Interest. Let's take a look at where stocks are trading, of course. About 23 minutes or so into the U.S. trading day, you can see we've now reversed lower on the S&P 500, the NASDAQ 100 too, but we know that we've seen a lot of volatility in this market. This stat coming from Bespoke Investment that the last time the NASDAQ was down 1% intraday, which happened yesterday, but finished the day higher by over 1%, was on the bottom in October 2022. So we'll see what happens from here, Sonali, but right now stocks are lower.
They sure are, and it's time now for the Wall Street Beat. We're going to talk about working conditions. Two of Wall Street's biggest banks are rolling out measures that may ease junior bankers' workloads. This comes after complaints about long hours, increasing complaints. JP Morgan now plans to cap hours for junior bankers at 80 hours a week. Bank of America, meanwhile, says it will monitor closely individual workloads. We are joined now by Katherine Doherty, Bloomberg's finance reporter, who has been covering this story really for the last couple of months. These calls have been building. There is a difference this time around. A couple of years ago when we saw the junior banker revolt, let's call it, it was about pay. It was at a time of a deal boom. This time around, deal volumes are coming back, but the nature of these complaints are somewhat different, aren't they?
They are. And the real question will be, are there changes that stick? Are there changes that actually make a difference after we hear these complaints? Because complaints are not new. They come up time and time again. As you mentioned, pay was one moment in time. But this whole issue and the tensions around the type of working conditions, the hours that bankers are working, the lack of sleep, their health that is deteriorating because of that. This is something that is not new on Wall Street. Veterans will say this is part of the game and that you have to put in the work in order to earn your space in the industry. And so now what we've really seen is pushback from the junior bankers, and some really very important moments in time at Bank of America. One of their bankers passing away after working on a very large M&A deal, and that really sparked an outcry, regardless of the really the rationale and the reason behind his saying. It just brought up a whole new conversation, renewed the conversation about working conditions. So now what you're seeing is the banks actually putting into place some changes. So for JP Morgan, capping the hours at 80, and for Bank of America, they're improving their system. So instead of reporting hourly workloads every week, the bankers will now be putting in their hours each day so that it's accurately tracking, or more accurately tracking, the type of work that they're doing.
All right, Katherine Doherty, really important reporting. Appreciate your time, of course, on that story that JP Morgan and others looking at ways to cap junior banker hours. Meanwhile, you take a look at markets right now, again, to the downside. Of course, we've seen massive volatility in the last week or so. Really, the whole month of September today is no different, to a lesser degree, but the S&P 500 searching for direction right now, and right now, Matt, finding it to the downside.
All right, coming up in the next hour, Nimrit Kang joins us explaining how she is taking advantage of this market volatility that we've been talking about, and the co-CEO of TickPick discusses dynamic ticket pricing and transparency. This is Bloomberg. We are 30 minutes into the trading day on this Thursday. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, stocks are fluctuating. Another faster than estimated inflation reading did little to change bets on Fed rate cuts.
And only tough options. Bloomberg talks to investors and insiders about Intel's long, stinging fall from grace.
Plus, a flurry of M&A news, from a General Mills yogurt deal to a last-ditch push to save the U.S. Steel takeover. All of that and more, but let's take a check on these markets. About 30 minutes into the cash trade, you can see, of course, we're looking at a down day right now for the S&P 500 and the NASDAQ 100. Of course, we saw that stunning reversal yesterday, which happened in the afternoon. So who knows what's going to happen later on today, but at least for right now, there is red on the screen. In the bond market, too, you can see yields up slightly, a tiny sell-off there. But of course, the 10-year yield still below 370, Sonali.
Fascinating trade indeed. We're going to dive deeper into these markets. We are joined now by Nimrit Kang. She is Northstar Asset Management Chief Investment Officer. Want to take a look at where we are month to date. We're almost halfway through the month, and you have changing expectations. Inflation coming in a little hotter than expected, enough to wipe out that expectation of that first 50 basis point rate cut, but still have that first rate cut on the table and at least 100 basis points of rate cuts still expected by the market. In effect, you see real estate, consumer discretionary, really interest rate sensitive sectors performing this month, whereas things like energy and financials are not feeling that same sort of love. Do you think that that trade extends into the rest of September, into the fall?
Sonali, let's put some context around the volatility. You know, on average, we see usually a 14% declines in market going back to the 1970s, even probably longer than that. And this is a presidential year, and we're at a cusp of an inflection in the monetary cycle where we're going to start seeing the Fed cutting rates here. So the volatility that we're seeing is pretty much expected, and one we are ready to take advantage of as it presents the opportunities here.
And let's talk a little bit more about the volatility, because there have been some amazing size and scopes. You think about the NASDAQ yesterday, down 1% at one point intraday, and then finishing the day up by over 1%. According to Bespoke, of course, last time we saw that was on October 13th, 2022, which of course ended up being the bear market low. Do you think about stats like that? Do you view yesterday's episode as maybe we're working through this volatility on track to higher highs?
Katie, it's in moments like this that we really focus on our three pillars of looking at the portfolio over our portfolio. And those three pillars for us are diversification, very important to be diversified across market caps, geographic region, business models. The second pillar for us is high quality. High quality doesn't go out of fashion, and when we talk about high quality, it's companies with low debt on balance sheets, high free cash flow generations, good, strong business models that are in control of their own destiny. And then lastly, long-term from two perspectives, and it's especially important in environments like this, long-term thinking, to know that, the volatility that we see, we really have to have a longer-term perspective. That's how you really win in the long term, but also focused on business models that we believe can deliver that compelling value proposition and compound returns over long term.
I want to get into the stocks or the sectors that you like, Nimrit, but first on the volatility, maybe a final volatility question, right? Because Greg Bottle was in here a couple days ago from BNP, and he said rather than buying stocks on the dip, he was seeing a lot of people buying vol on dips. Are you buying volatility here? How do you execute that trade if so? And then when does it dissipate?
We are long-term investors and not as much traders, but the way we really think about volatility is to take that long-term perspective. And yes, the volatility creates opportunities. So if you've done your research and you're waiting to enter into positions and you have not been able to do that, now is the time to do that and take opportunity of those, advantage of these opportunities.
To that end also, and by the way, Matt, I don't think we can go too deep on volatility.
That was the last question on volatility.
It is the last question. I'm cut off on volatility. I want to talk about single stocks, actually, because you did highlight, for example, PayPal being an interesting idea for you. And I find that interesting given what we've seen in financials this week, a lot of worries about what change in interest rate environment would mean for interest rate sensitive financials. Why is PayPal attractive to you?
We have been long-term holders in PayPal, and we have suffered our share of underperformance with this stock. But we kind of find this a very exciting and interesting opportunity or an idea because of the new management that's in place. We had a long-term Intuit veteran join PayPal as the CEO last year. He's on to his first year, Alex Chris, and he's doing a really good job in getting the company to focus on monetizing their brand equity. PayPal is a household name. How do you turn that into a growth driver? How do you outcompete a very competitive market? Those are some of the things that we're focused on. Just in their last quarterly results, we actually got indications of some green shoots. They grew their total payment volume by 11%. Their white label offering Braintree or the unbranded checkout also growing at double digit, and they're doing very well with Venmo. They're also launching a new campaign, which we as consumers should start to see everywhere, PayPal everywhere. So all those data points to give us some comfort that maybe the company is moving in the right direction. And I think, Sonali, the other things, going back to our thesis on high quality and looking at companies that are not dependent on external financing, PayPal is a net cash balance sheet. They generate a lot of free cash flow, and they're buying their stock. And again, just holding a diversified portfolio of stocks, you don't have to be all in type of a turnaround stories like PayPal, but it's good to have a few of these in the portfolio.
I mean, I see the benefits of PayPal and have been using it lately with Venmo on eBay, but I'm just wondering if they don't face really stiff competition from, Apple. If you're in the Apple ecosystem and you can use Apple Pay, that makes more sense to me. Or if you're in the Google Chrome ecosystem and you can use Google Pay, that makes more sense to me. I think Meta has its own pay. It seems like a very competitive space. What gives PayPal, do you think, the edge up?
You're absolutely right. It is a very competitive space. And the one benefit of competition is it really forces innovation. PayPal, yes, you can say they're on Apple Pay, Google Pay. You can use the PayPal offers the plumbing behind what you see on an Apple Pay and some of these other offerings as well. So they don't, they don't have to win. They can win in multiple ways. They don't have to go head to head with an Apple Pay or some of these very strong brands, but they can still provide the plumbing. They can still be that safety, security solution that the consumers can trust and feel good about, rather than, putting out their information everywhere on the internet.
And I want to zoom out a little bit. I mean, you mentioned when it comes to PayPal, you're a long-term holder. Of course, you've seen your share of disappointment when it comes to the stock performance. But I want to hear a little bit more about your process. When you're evaluating single stock opportunities and considering adding a name, I mean, what does your decision tree look like? What are some of the factors that you have high up there?
Yeah, our process is very much focused on, first of all, identifying companies that have a track record of delivering high quality returns on invested capital, cash flow returns on invested capital. That's probably the big criteria for us, married with very strong balance sheets. Another key criteria for us is, are these management teams that we think are committed and have a history and track record of adding value, delivering value? But we don't stop there, Katie. We marry that with, you can have a company that's been high quality compounder, but how do we know that it's going to continue to be that high quality compounder in the future? That's where we think that thinking about what are the long-term trends, secular trends in place. We married the analysis on high quality companies with that forward-thinking analysis. And then, of course, we do a lot of deep dive into the cultural DNA of the company. How is the company really thinking about not just the financial returns, but also about their employees, the culture, the planet, their communities? All of that is a part of our process.
Well, just quickly, we only have about 30 seconds left with you, but has that list changed over the past year or so? You mentioned, balance sheets, free cash flow example, but you also mentioned management. We know that CEO turnover has been high. Are you taking a closer look at the C-suites?
We are always taking a closer look at the C-suites. And one of the things that we do very quickly is we go back and look at their track record. We follow what they're doing, not what they're saying. And that's very important to us.
Nimrit, thanks so much for joining us. Really appreciate your time today. Fascinating to hear about your process. Nimrit Kang there, Northstar Asset Management Chief Investment Officer. Let's get now a look at the stocks moving at this hour. Just about 40 minutes into the trade. For that, we get over to Abigail Doolittle. Abby, what do you got?
Well, let's start off with what's working, and that is Warner Brothers, one of the top stocks for the S&P 500. This after they signed a new distribution deal with Charter, which of course is the nation's largest pay TV distributor. So Warner Brothers channels such as CNN, Food Network, TBS will now be on Charter in a bigger way. So investors excited about this, up 5.1%. Kroger also higher, the best day, I believe, since March. This after the grocery store raised its sales outlook on resilient grocery spending. They're also saying that lower prices and personalized options really helping them out. So again, a nice pop there. So another interesting tell here on the consumer spending on food. And then finally, one big laggard, Moderna, down very sharply, down 18.3%. This is the worst day in about a month, so not such a long time. So this stock, this company has struggled because since the pandemic peak, down 87%. Today's reason for dropping, they are cutting their R&D outlook. They're also trimming that pipeline as they struggle to figure out what's next after vaccine sales have slowed.
Abigail, thank you so much for your reporting. I also want to bring you some breaking news here. Verizon Communications expects severance charges of $1.7 billion to $1.9 billion in the third quarter as it pursues job cuts. It expects a voluntary separation program of about 4,800 eligible employees who will separate from the company by the end of March of 2025. Verizon also, in a regulatory filing, said that it plans to stop using certain real estate assets, plans to cease use of them, and also exit non-strategic portions of certain businesses. Keeping an eye on Verizon shares down almost 0.5%. Now, coming up, we're going to talk about Intel. The board has been huddling this week to discuss options as the business struggles to keep up with the AI race. Details on that next. This is Bloomberg.
Let's get now to high interest, a look at what's making headlines around the world. China is turning up the heat on its army of 8,700 investment bankers. At least 3 top executives from different securities firms have been detained by Chinese authorities since August, sending a chill through the industry. Read more about that on the Bloomberg terminal. UniCredit's CEO said that a full takeover of Commerzbank is an option after the Italian bank announced it had acquired a 9% stake in the German one. The move comes as a shock, jolting European banking and catching German Chancellor Olaf Scholz off guard. Here's what Orchel had to say about why Europe needs more cross-border consolidation.
The ultimate goal is what everybody talks about. Europe needs stronger banks. Europe needs cross-border. Europe needs banks that are capable to support its industry and the development of Europe so that we are an economic bloc that can hold its own against the US and China.
Andrea Orcelli, the CEO of UniCredit. Billionaire Jared Isaacman and SpaceX engineer Sarah Gillis made history this morning. The pair performed the world's first commercial spacewalk, leaving the Crew Dragon craft and conducting a number of motions to test out the mobility of their fancy new spacesuits. The Polaris Dawn mission also made history by sending its crew 870 miles above Earth, further than any humans have traveled since the Apollo program landed on the moon. And BlackRock and Partners Group are teaming up to offer retail investors access to a variety of private markets through a single portfolio. The firm plans to create a one-stop portfolio to provide access to private equity, private credit, and real estate assets at a time when demand for those and other alternative assets is rising. Katie?
All right, let's switch gears here and check in on shares of IBM. The tech OG hit an all-time high this week for the first time in a decade as the company capitalizes on the opportunity in AI software. We should also check out shares of NVIDIA after shares popped yesterday, adding more than $200 billion in market cap, really saving the entire market in the process. And that, of course, brings us to today's big take. Intel's board is meeting this week to weigh options after a dismal earnings report last month. Those options include scaling back multi-billion-dollar factory projects, selling off subsidiaries, or even splitting into separate companies, Bloomberg has learned. Let's discuss with Bloomberg Intelligence senior analyst Mandeep Singh. And Mandeep, it's just been a stunning fall from grace. Obviously, there's a lot of heat right now on Pat Gelsinger, but he took over in 2021. And just give us some context on how bad of a hand he was dealt.
Well, when you look at Intel, there are 2 main segments. One is on the design side, what they're doing with PCs and data centers. The other one is the foundry side. I think it's
wait. One of those exists and the other one does not, right? I mean, how much of a foundry business do they have?
Well, it's pretty sizable. In fact, that's the money-losing part that is really weighing on the gross margins. So Intel gross margins went from mid-55% to less than 40% this quarter.
The question is whether the customers exist, right?
Yeah. And so, look, Intel uses its own foundry. So the reason why they had a big, sizable foundry business, they opened it for external clients, but they use their own foundry to make the data center and the PC chips. So it's not that it's all for customers, it's not working out. The problem that Intel has is on the data center side, when the whole market is growing, in the case of NVIDIA, growing 100% plus, they are losing share. Their data center business went from $20 billion to $12 billion. Mm-hmm. And that's where, when you have such tailwind, when you're such an environment, you have to find a way to participate.
It's interesting. At the end of this meeting, we have reported here at Bloomberg that this is somebody, Pat Gelsinger, who may not be expected to right away come out with a decision at the end of this meeting, but we have a sense of what the options are. In your view, are any of these options good options?
The best option here is to figure out a way to divest the foundry business because, like I said, it's almost losing like $7 billion a year, and it's a very high fixed cost business. You have to invest in fabs. They're getting the money from the US government to invest in the fabs. But still, I think they just have to find a way to focus more on PCs, their core business, and AI tailwind is there. That's the one big driver for every semi company out there. They have to find a way to participate in that AI tailwind.
How much input does the U.S. government have? If they're going to put in, $20 billion for Intel to build a factory in central Ohio. Shouldn't they have some sort of say in, whether or not Intel splits up these businesses?
I mean, I look at it this way. All the hyperscalers plan to increase their capex to build AI clusters. Why can't the government convince one of these hyperscalers to use Intel Foundry?
Right. Well,
and that's the solution.
Well, that's the big question. I mean, in a detail in this story by Ian King, fantastic reporting, is that Commerce Secretary Gina Raimondo has tried to help the foundry business, of course, encouraging the likes of AMD, NVIDIA to consider manufacturing at the Ohio facility. Apparently, that's not working. Why don't they want to actually do that and partner up with Intel here?
So that's where the process node capability comes in. TSMC, when they say they have a 3-nanometer process node at scale, they're making all of NVIDIA's chips as well as Apple's iPhone chips, the latest one, iPhone 16. And Intel is just not there when it comes to the foundry side, the leading node manufacturing that everyone needs to participate in these mega cycles. So that's the missing element. And that's where, separating the business may make sense because you need separate execution on the foundry side and the design side.
It's interesting. On a separate note, we have also reported here at Bloomberg that OpenAI is in talks to raise $6.5 billion at a valuation of $150 billion. That is almost double the market cap of Intel. Does this say anything about the changing winds of this space, where investors are willing to allocate capital and where they're not? Is it problematic that you have a situation here where the Intel story is so reliant on the U.S. government?
Look, I mean, if OpenAI was to go public today, they would fetch a much higher valuation. And when you look at moves, NVIDIA moving $200 billion in market cap in one day, it doesn't surprise me that OpenAI's next round was much higher. And this is the trend right now. This is the mega trend, and all the companies that are exposed to it will fetch premium valuation. So I think OpenAI getting a $150 billion valuation is not surprising in any way.
Mandeep, we have to leave it there. That is Bloomberg intelligence analyst Mandeep Singh. Of course, a lot going on in this space, and we will keep an eye on Intel throughout the course of this story. Now, still ahead, no more soup for you. Campbell's Soup is changing its name.
No soup for you.
No, okay, I can't do it, right? It's changing its name after more than a century. We'll have details in Social Climbers next. Maybe we'll let Matt say the tagline. Stick with us. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Campbell's Soup is dropping the soup, at least from its official name. The 155-year-old company, which sells everything from vegetables, snacks, and salsa, it wants to rebrand itself as the Campbell's Company. Of course, that new name is subject to shareholder approval, so watch this space. Next up, Disney's fight with DirecTV is costing the companies. Disney's Monday Night Football broadcast on ABC and ESPN attracted a TV audience of about 20 million viewers, which of course is a drop of nearly 10% from last year, reflecting the blackout of DirecTV's 11 million customers. And finally, McDonald's is extending its $5 meal deal into December as it battles for budget-conscious consumers. The fast food giant announcing it will offer local promotions and app-exclusive deals throughout the fall season. And of course, you can follow all the latest company buzz on TRE and Go on your Bloomberg terminal. Meanwhile, let's take a check on these markets, of course, because we have another reversal on our hands. If we take a look at the S&P 500, you can see right now currently up 0.2%. The last time I showed you this board, it was down 0.2. So there you have it, that volatility we've been talking about. And then you take a look at the NASDAQ 100, currently leading gains at the moment, of course, currently up about 0.4%. And the 10-year yield, a little bit of a sell-off underway in bonds. The 10-year Treasury yield up about 3 basis points, Matt.
All right, coming up, your ticket to the C-suite. We'll speak with Brett Goldberg. He is the co-CEO of TickPick. That's coming up next. And looks like we have, Sonali, some breaking news on Stephen Cohen's hedge fund.
Yeah, absolutely fascinating here. You have Point72 planning to return some cash to investors for the first time. We will bring you more details on that story as it comes. But of course, we know that it has been a very hot market for multi-strategy funds, and they have been the place that money is going. This is Bloomberg.
At a time when ticketing companies are in the news for pricing controversies, TickPick has been spearheading price transparency. Joining us to discuss his company's approach to the ticketing business is Brett Goldberg. He's the co-CEO of TickPick. Brett, thanks so much for joining us. It's a difficult name to say without getting in trouble. I'm not sure if you chose that on purpose.
We started the business in 2011, before that was a thing.
I got it. So before Anthony Weiner. So let me ask about the transparency. How do you do this in an industry that seems so opaque? There seems to be kind of, I don't want to say a monopoly with one business, but you know, people don't trust it. So how do you change that?
I think it's pretty interesting. In the ticketing space, it's one of the few places where when you're honest and transparent, it's a competitive advantage. So unlike virtually every single one of our competitors that is hiding fees, when you actually do the right thing for the consumer, over time they're going to learn, they're going to trust you, you're going to have higher repeat rates. So it's a competitive advantage to do all-in pricing, do what's right for the consumer.
And so it feels like the entire public has learned what dynamic pricing is in the past couple years. Do you do dynamic pricing? I mean, how does your model work? I know that you, of course, are all about transparency, but how does the business model actually function?
So as a marketplace, it is supply and demand driven. We're just sitting in between. And you know, sports teams have embraced marketplaces, so sports teams' inventory may be directly on marketplaces. And there is dynamic pricing. We're not really doing it because the suppliers are doing the dynamic pricing, changing that in real time. We as a marketplace, then those prices change in real time.
How do you provide more transparency, especially at a time where you have so many consumers really trying to get out there, again, get into entertainment venues, but also feeling their wallets quite pinched at this point in time?
So for us, when we started the business in 2011, we just looked at what Amazon was doing as a leader, and we said, how do they price? And no one outside of probably ticketing and hotels are there hidden fees at this point. So we said we're going to show all-in pricing. We're going to do what's right for the consumer. It is hard, though, because when someone price shops on TickPick, they see a certain price, and they see a price on a competitor that's much less. And some of these marketplaces make you actually put a credit card in before you'll see the total price. So it is harder. You have to kind of keep telling people, like trust us. And once they use us and then realize it's cheaper, because we're making 14, 15% on a sale, where they're making 20, 22%. The reason and why we're able to do that is we just have higher repeat rates, so we don't need to go reacquire that customer.
It is infuriating to, you know, see a price on, you know, the dominant ticketing site, and then when you click through and see that they're also charging you fees and adding taxes and then more fees, it ends up being, you know, double sometimes what you see to begin with. But for the artist or for the seller, I imagine scalpers are the most infuriating issue, right? Because if Taylor Swift wants to sell Katie a ticket for $100, but Katie wants to buy 10 and sell them to Sonali for $1,000 apiece, Taylor's leaving a lot of money on the table.
I always thought Matt would make a great scalper. I've said it.
I know you think that. I've never scalped tickets.
You know,
well, not for years.
The word's interesting. I think we like to think of it as like maybe a ticket broker. You know, and I think what's happened is the space has actually gone much more professionalized. So unlike what we used to think about a person on the street corner selling tickets and you're not sure if you're going to get in, it's been very professionalized. They actually, you know, I think the concert side, your Taylor Swift example, is a hard one, right? Everyone wants to go to that. Supply and demand just, you know, she's putting on 50 plus concerts. She could put on 1,000 concerts and would sell them all out.
Yeah.
So there is this balance of supply and demand there, and she's selling them below what the demand is. So it's very challenging. Most artists want to sell out, and brokers are actually helping sell out. And I'd say, you know, probably 60% of the time the broker's making money. A lot of times they're actually losing money, and they're actually helping the artist sell that next show and getting an indication of what the demand is. So I think it's a pretty fluid market. Live Nation talks about this all the time. It's not like they're saying, we hate ticket brokers, we don't want ticket brokers that exist.
Well, with the Taylor Swift example, I know plenty of price-insensitive Taylor Swift ticket buyers, at least in my personal life, but it's the same sort of dynamic if you think about sports. I mean, there are people who love their sports team. That's basically their religion. And it's interesting. We were having this conversation in the commercial break. We don't really have this conversation around ticket prices with athletes and athletic games like we do with artists, musical artists.
Yeah, I think there's a different social dynamic where in the sports world, it's okay to brag about sitting courtside and spending tons of money. And in the concert world, the artists get scrutinized if they're selling tickets for high dollar amounts. So they almost have to cap themselves out at what they're going to sell, and they sell below what the fair market value is.
You know, you have, from what I understand, a partnership here with the Philadelphia Eagles. Anybody who watched last week's game in Brazil, it was pretty fascinating to see what happened. Something I was wondering is, as you see these sports leagues in the U.S. move abroad, really capture that global market share, who's going? Is these Americans traveling abroad to follow their favorite teams, or are you finding more and more interest globally for these kind of iconic American sports franchises?
They're trying to grow the sport locally in those destinations. So it's not about getting Americans to travel to Brazil or the UK. They're trying to build their fan base internationally, and they're doing it quite successfully.
How do you start a business in an industry that is so dominated by Ticketmaster and StubHub? I mean, how do you have the cojones to even try?
How much time do we have?
Yeah.
You know, myself and my business partner, Chris O'Brien, we started 2011. He's a computer engineer, so we went and built it ourselves. I think our timing was good. It wasn't fully developed yet. So we kind of saw StubHub charging 25%. We said it's going to be so easy to undercut them. No one should be making that amount of money in this space as a marketplace. So that was the thesis, that we could just do it better and cheaper. And 13 years later, we've kind of proved out that thesis. But your point is, like, we've been a startup bootstrapped from 2011 till 2019. We raised some growth equity then. And then we just recently closed a large round through Brighton Park Capital and Rory McIlroy.
Well, I mean, building on this conversation, would you ever consider a merger with one of your competitors? Do you see industry consolidation in the future here?
That's a good question. It's something that we're certainly talking about. You know, we're going to do about $1 billion in GMV ticket sales this year. You know, Ticketmaster resale is probably the largest marketplace at $4.5+ billion. They don't break that out. You got StubHub that's out there and Vivid Seats. So you are number 4 or 5 player. We think we can keep growing, and we're certainly looking at M&A and international expansion.
Well, when you say that, are you looking to acquire others, or are you looking for an eventual sale? You've been talking about your investors. Is there kind of an exit horizon that they're looking at here?
So we just closed the round, so we're looking to buy things.
Yeah, you have the money and you can do it. In terms of international expansion, is the market different overseas? And I mean, here in New York, I know people will pay anything for a ticket because we have such wealthy people, right? I didn't feel the same way in Berlin. So what's the difference between, you know, European, South American, U.S. markets?
They're about 10 years behind us, and they would say themselves in the development of this industry there. UK, very transparent, so it actually works really well for us. They actually require the all-in pricing. Federal legislation here has been ticked around for the last 5 years. We'll see if that ends up happening. So we think we can compete in the UK, but some of the laws in different countries are all different. Some of them kind of restrict some of the resale there.
All right, Brett, really fascinating perspective. Great to spend some time with you. Hope to have you back after you do buy something. So maybe we'll see you again soon. Our thanks, of course, to Brett Goldberg. He is the CEO of TickPick. Meanwhile, let's get a check on these markets that can't really decide what they want to do, Abigail Doolittle.
That's true. We have had mixed markets today, but right now we are very much in the green cross index too. Take a look at the S&P 500 and the NASDAQ, both up about 1/10 to 0.2% after having been lower. The New York FANG index, though, really leading the way, up 0.7%. It is worth noting that these three indexes all up 4 days in a row. So we're looking at a little winning streak here after some volatility last week. As for what's behind the strength, in particular for the NYSE plus FANG index, of course it's big tech, but I would argue it's one name in particular. And of course, this is NVIDIA. This is probably the reason that we have these indexes up 4 days in a row. So as NVIDIA goes the market over this time period up a really remarkable 16.3%. Nothing has changed so much from the quarter that they reported that was good, but not amazing, too far, too fast. But what has changed, it seems, some dip buyers stepping in. The question is, will their dip buying be successful? Let's check back in on a chart that we've looked at before. And one reason to look at the chart of NVIDIA is because of its big weighting to the S&P 500. So this is a one-year chart, and it's amazing that last year this stock essentially trading at $40 per share on this split-adjusted basis. And then we have this uptrend, but what we have going on here with these fan lines marking a reversal. Again, the point of a trend line is not to show the trend. You can simply see that. It's to see when the trend starts to reverse. So this uptrend trend is starting to reverse within this triangle area. It could break out higher, but it's more likely to break out lower only because it's a progressed reversal. And if we were to do some other technical work, it would suggest that. But in the meantime, there does appear to be a reprieve for the bears. We very much likely get back to the top of that range. Let's call it around 125 or so, and then more likely back down. And then it's going to be interesting to see when this range breaks. Will it break up potentially? Will it defy the gravity here as Tesla did back in, I think it was 2014? Or, Sonali, are we going to see it go back down toward last year's lows? Because that's what this reversal suggests would happen if, in fact, that reversal occurs.
A lot of movement. Bloomberg's Abigail Doolittle, we thank you so very much. And coming up, General Mills trying to make some cheddar as it exits the yogurt business. We're going to unpack that pun next. This is Bloomberg. It's a Yoplait payday for General Mills.
Yes.
I can't say it without laughing. The food giant announcing today that it's selling its North American yogurt business to French dairy companies for a little over $2 billion. General Mills is exiting the yogurt market as competition from Danone and Chobani heat up. Here with more details is Bloomberg Deals reporter Michelle Davis. Because this is a bit of a trend in the deal market now. You have companies slimming down, really focusing on their strategy. In this instance, it is General Mills looking at premium pet food and organic snacks. What do you think of this deal?
I mean, it's exactly as you said. There's a big trend of companies looking to just streamline their businesses given how uncertain the future is. We don't know who's going to be president next year. We don't know what rates they're going to, be at. And so companies, especially in the consumer sector, where consumers are being a little more conservative, they're focusing on the areas where they think they can make a really big difference. And for General Mills, that means pet food, it means snacks and organics, but not yogurt.
Not yogurt. I want to talk about
But most people are still eating a lot of yogurt.
Yeah, not me.
I'm eating
Not
like
me.
300 grams of yogurt a day.
I
eating
have it every
ciggies.
morning.
You?
That doesn't
a lot of protein.
like weigh like a stone in your stomach. That's a
This
lot
has
of
taken
dairy.
up like 2 hours of our morning.
It's throughout the whole day.
conversation.
Okay,
Yeah.
you spread it out,
Yeah.
of course.
It's
That's
good for your
important.
gut.
That's true. That's true.
Stock is down today.
Stock is down today.
If they're slimming down, why are investors not getting more excited about it?
So Bloomberg Intelligence put out a note earlier this morning that said even though you would think they'd be using this, to maybe bolster their balance sheet, leverage is going to go up. Debt to EBITDA is going to go up after this deal because they're going to be using the proceeds to buy back stock. So that could hinder their ability to maybe be as aggressive on the acquisition front in the future.
Let's talk about a deal that just can't get done. I'm talking about Kroger and Albertson. Kroger actually out with earnings this morning, raising its sales outlook, of course, resilient grocery spending. It's basically the definition of a staple, but what's the latest there? Again, it just feels like the timeline keeps getting extended.
So yeah, I mean, the big overhang, despite the fact that they lifted guidance, is that we don't know when or if the Kroger-Albertson deal is going to close. They are currently in Oregon right now, arguing to a federal judge why they think the deal with Albertsons should close. The FTC has sued to block the deal. The FTC is trying to convince this judge to issue an injunction that would stop the deal from happening. There's an outside date later this fall, so Albertsons and Kroger are working to get this approved before then, but it just all underscores how difficult it is in this environment, not only to get deals to announcement, but to closing.
And there's not even anybody Japanese involved. I mean,
Exactly.
That's really difficult, right?
Right.
You've got two deals right now. One is a Japanese steelmaker that wants to buy U.S. steel. The Biden administration has said, no way, Jose. And then you've got Couche-Tard, a Canadian company that wants to buy 7 & I, which is a Japanese owner of 7-Elevens. Are they both going to be nixed?
Well, the Couche-Tard one is still, I mean, it hasn't even gotten to the point where regulators can say anything about
And that's
it.
a price issue so far, right?
Right. Couche-Tard is reportedly going to increase its offer for 7 & I. It's TBD whether 7 & I will engage. At this point, they haven't. But that's before you even get to any of these regulatory issues. The issues around Japanese company, U.S. or Canadian company, I think are a little different in the U.S. Steel situation than this one, but it is a fair question.
Michelle, before we let you go, I want to talk about another deal today. We are seeing multi-billion-dollar deals. MasterCard is going to buy a $2.65 billion company here. Recorded Future. Financials are buying tech companies.
What does Recorded Future do?
It's a cyber defense firm. You're going to yell at me.
No, I'm not. It's just that the Flack told us it was a global threat intelligence company, and I thought that sounds made up, but you're paying $2 2/3 billion, so probably not.
But it's a private equity exit, isn't it?
It's a private equity exit, so I mean that's rare these days. Private equity firms have been holding assets for the longest time ever, you know. And when they are exiting, it's not to private equity; it's to strategics. So this is an example of that. Home Depot bought a big company from a private equity firm earlier this year. But, you know, cyber is the buzzword. Everything's dangerous out there, so.
The threat landscape is threatening, is what you're saying. Great reporting, as always. Really appreciate that roundup. Our thanks, of course, to Bloomberg's Michelle
There's a lot going on. There's a lot going on. And they go.
Absolutely.
I knew
have
we were
great
going to launch
functions
this
on the
show
Bloomberg terminal.
Right into Deal Boom.
All right,
Just
coming
saying.
up, we head to Washington as Nippon Steel tries to salvage its takeover of U.S. Steel. A lot to cover there. This is Bloomberg. All right, let's get a check on these markets because once again, we're in the green right now. At least if you take a look at the S&P 500, the NASDAQ 100, both up 0.2 to 0.3%. NVIDIA once again saving the day here, up almost 2%. It's the biggest points contributor to those indexes right now. The 10-year Treasury yield still up about 3 basis points. Mild moves, all things considered, Matt.
Yeah, absolutely. We don't see the swings, at least yet, that we saw yesterday. Let's get to one of the deals we just spoke about with Michelle. Nippon Steel is mounting a last-ditch push to muster support of any kind, I guess, for its $14 billion proposed takeover of U.S. Steel. The Japanese steelmaker sent a senior executive to Washington, D.C. for meetings this week as the deal risks being blocked by President Biden at the White House. Josh Wingrove, Bloomberg White House reporter, joins us from D.C. So, Josh, I mean, what are the chances? Is it at all possible that this deal could be revived in the face of potential job losses, American job losses?
I mean, it's not clear whether Biden will buy that, but that is the goal of the proponents of this deal right now. And this, I mean, I'm trying to remember the last time we've had something that has filled my IB chats so quickly with people parsing every bit of information that we've had on it. But, you know, Biden has stated his opposition to it. He's given no public signal that he's backing off that. But there's a lot of questions hanging in the air. One is the timeline that they have to make a decision with. There's a sense of urgency coming up that it feels like they're up against it, and that could lead to a decision coming soon before the election. That is leading to questions about whether there would ultimately be some sort of extension, whether the government or the CFIUS process would allow that, and more broadly, whether Biden is feeling any blowback. And it's a complete eye of the beholder scenario, right? The reports came out a week ago, just over a week ago, that Biden was planning to kill this thing. As of yesterday, it had not hit his desk. And so in the interim, in the last week, people have been wondering, is this delay just bureaucracy, or is this delay a sign of cold feet? And it's just right now totally unclear. For our story, though, we did speak to some people in and around Pittsburgh, including USW members. USW leadership, the union, hates this deal and opposes it. Some members don't hate it, think it's good for their jobs at their plant. Some local leaders also in favor of it. So the politics of this are at least a little bit mixed.
Well, Josh, you bring up exactly where I want to go, and that's the unions. Really, that feels like the key to this deal. You mentioned that, you know, union membership, leadership hates this deal. Do the people advocating for it have any shot at winning that leadership over?
They're hoping so, but they're sort of clearing the decks a little bit. They took the extraordinary step yesterday of publishing their correspondence with the head of the United Steelworkers, Dave McCall, saying, you know, trying to illustrate that they are willing to sort of talk and meet whatever demands. The core objections of the Steelworkers Union, the executives, is that they want this deal to be signed by Nippon Steel's parent company and not its subsidiary. The company sort of made overtures that they'd be willing to do that, but not really committed to it fully in the eyes of the union. And there are other questions like how profit sharing would work with it being a private company. and sort of other fine print like that. Broadly, you've heard complaints from the company, or at least, if you're reading between the lines of them releasing all this correspondence, that they don't seem like they can get a hold of him, or it doesn't seem like the talks are happening. But what's not clear to me, and I think not clear publicly, is Biden has not said what John Fetterman has said. John Fetterman, the Pennsylvania senator, has said, if the union is for it, I'll be for it, but right now the union's against it and I'm against it. Biden has not said that. So Biden has not said, if the union's on board,
Josh,
so will I. He's left that unclear.
Josh, it's interesting. In the heels of your report, you have seen that the share price has really recovered a little bit here relative to what you've seen. The market likes this deal, clearly, and you can understand the union's concerns. What I can't understand is what are the real options for U.S. Steel despite Nippon? There's some talk about Cleveland Cliffs, but ultimately, if Nippon did not buy U.S. Steel, wouldn't these jobs be at even greater risk?
That is the concern of some of the rank and file that we spoke to. Again, it's not clear that they represent a majority and minority. Some of them are saying that they think all their rank and file are with them on this. But what they are looking at is not only the purchase price, the $14 billion, which at $55 a share is way above the trading price now. The stock has been on a tear, but there's still a big gap there. So if people are making bets, maybe who knows? But it's a huge gap still. But what they think is also the $2.7 billion that Nippon Steel is committed to invest, in particular at least $1 billion in what's called the Mon Valley. These are 3 of the plants just outside of Pittsburgh. This is really the heartland of U.S. Steel. And so they think that's where it is. If this deal dies, U.S. Steel is saying they won't make the investment. Nippon Steel is saying they bet no other company will make the investment. Cleveland Cliffs, which is American-based and therefore would be in line with Biden's belief that it'd be U.S.-owned, they have said that they might be interested, but at a much lower share price. It's possible the company stays U.S. Steel. It's possible it gets broken up. It's not really clear right now. But what is clear is that the U.S. Steel and Nippon Steel still want this deal to go through. Biden's threat is sort of hanging over it all.
Up against the clock. Really appreciate your reporting. That, of course, is Bloomberg's Josh Wingrove in Washington. Quick check, of course, breaking news. Berkshire Hathaway's Jane sells over half of his Class A shares. You're seeing that in the stock right now. Of course, we're going to closely cover that on Bloomberg TV. This is Bloomberg.